And all right, you see that?
Yep.
All right. So yeah, thank you guys for joining us tonight. I'm really excited about our guest speaker because I like to geek out on this stuff. It's really exciting to me to see the power of real estate and how you can. Um, you hear a lot about how the wealthy don't pay taxes. Well, the reason they don't pay taxes is because they use a lot of powerful strategies that we're about to talk about tonight. So my name's Ryan. I'm down here in Eugene, Oregon. Been investing for about a year and a half. I'm invested currently in a 160 unit apartment deal in Phoenix as a limited partner. And then I also have a 50,000 square foot self storage portfolio out in Mississippi. That's a joint venture structure on that one. And then my objectives for tonight and for all these meetups is just to add as much value as I can. I want to help educate you on in the space. And I want to create relationships and create opportunities for you to create relationships because you never know when you're going to meet your next partner. And if there's anything I can help you with, feel free to text me. My phone number is there. And then these QR codes next to our headshots, that'll take you to our LinkedIn pages if you would like to connect there.
Well, and I'm Chris Freeman. And so I'm up in Portland, Ryan's down in Eugene, and we both had a multifamily masters meetup group. It's call it a franchise. There's a brand called MFM, and we each have our own meetup. But as a pandemic hit, we said, well, we're all doing it virtual. Why don't we just combine forces? So we've just been calling it the Oregon one. But at some point, we'll do maybe some in-person ones more locally just to reconnect with people. So welcome, everyone. So I'm based in Portland, and I've been investing in multifamily properties for about 20 years here, all in the Oregon marketplace. So most of my assets are in Portland. I do have a property out there in Madras, 26 units. So I personally have about 110 units. And then I'm a general partner on 333 to be exact, all in the Southeast, and just continuing to, I haven't really bought anything in Oregon in 5 years, but we've been focusing outside of Oregon, mostly just in an effort to diversify. So always looking at deals really in the South Carolina, North Carolina, Atlanta, and Florida markets. Personally, I've also passively invested in about 6 multifamily properties for over 1,000 doors. A big chunk of that is through my IRA. Some of it's outside. And I started doing that to get a better feeling of how syndications work before I went and did my own. And I have my brand is High Tech Freedom Capital, and I have a podcast called High Tech Freedom. And it's not a real estate podcast, but it really is kind of blending what I do in my W-2 job around high tech sales and bringing in the investment piece of it. So, I'm always learning in this space, but I do have some experience operating, owning, made some mistakes along the way. So I'm happy to help anybody that's looking to, start to grow. Maybe they're running into a problem around rentals. I've done some short-term rentals. I've tested out a few of my units with that as well. So reach out anytime if there's something I can help out with. And by the way, my meetup objective is not lean, earn, invest. It's learn, earn, and invest. So a little misspelling on my part. Sorry about that.
Yeah, that might be me. I put this thing together.
I wasn't going to blame you.
Yeah. So, and then real quick, guys. So, agenda for the evening. We just went through some intros. We'll get into a quick little 5 minute icebreaker, networking. Turn the cameras on. Get a little bit of energy. And give Larry a chance to present on what he's got for us tonight with some question and answers, and then more networking to close it out. So, Larry, you want to just do a quick intro, and then we'll get into some breakout rooms.
Yeah, I don't have a fancy slide and all that stuff, but that's just but Larry Pendleton, I am not in Oregon. I am in Virginia, so it is 8:45 on this side of the world. But great up here, met Ryan. It's been a year.
I
Has
think
it been a
so.
year?
Yep. Yep.
Um, uh, well, at a Secret X multifamily investor networking, which is somewhat associated with multifamily. merge those two worlds together. So PC Financials is what we were solely focused on servicing other real estate professionals, and helping them save as much money as they can, from the properties that they acquire. And looking forward to, hopefully I can add some value, answer some questions, and meet some great folks and go from there.
Awesome. Well, what do we got? 9. Let's do 3 rooms. Okay. Go ahead, guys.
In progress.
Hi,
Hey, Suzanne.
are you there?
Am I here? Sorry, my connection is not great right now.
All good. I can hear you.
Okay. So you said you're out in Central Oregon?
Yep, I'm in the Bend area.
Oh, cool.
Woke up and it was 2 degrees this morning, so pretty cold.
Oh, I had you beat by 16 degrees.
Woo! Yeah, it's chilly.
Hey, Daniel, I don't know if you're there, if you're still driving.
You kind of broke up there. Daniel, are you driving? Sounds like it.
Okay. So Suzanne, how long you been in the real estate game, in the real estate world?
I've been investing since 2014. I'm really impressed with your numbers. After a year and a half, you've got a lot happening. I just kind of did like the slow and steady, had a W-2 job. My husband and I aren't married, so not technically, so we would, kind of do one primary each year and kind of move here and there. And he's a contractor, so he fixes them up. And yeah, it's worked out pretty well, but I'm getting ready. Like, this is the year I want to do some bigger stuff, some out of state stuff. I'm ready to take my money outside of Oregon. So.
Gotcha. Yeah. Is that similar to Chris, just kind of trying to diversify, or are you trying to get out of the statewide rent control, that type of world?
A little bit of both. We fared really well during COVID. We had all of our tenants paid. Most of them know us, even though we have a property manager. So we tried to keep just a human relationship with our tenants.
Yeah.
Did some just tenant appreciation things. So we did all right, but I guess I don't know, with everything continuing to change, and I'm guessing will be less landlord friendly. I just want to diversify and have some different stuff in different states, and also be able to buy something under 500,000. So.
Yeah, right. Yeah, that's what initially drew me to Phoenix and how we got invested in that deal.
Oh, really?
Yeah, we were looking heavy there because, in my mind, it was like, oh, Oregon, very anti-landlord. Statewide rent control is just less than a year old. So went to a state like Arizona, and then Phoenix, of course, just popped up on every best multifamily Google search. So yeah, we got really lucky in that deal. That deal's actually up for sale right now.
Oh, nice.
Yeah.
That's awesome. So what are you going to 1031 into something else?
It's really going to be dependent on the sponsor of that deal. So we're just limited partners in that one. I imagine we'll probably just exit, but we'll probably look to do another syndication LP investment in that market. We like the liquidity of it. If you can double your money in 15 months, like this, it's really hard to beat.
Yeah, that's amazing. I know Chris was talking about self-directed IRAs just briefly this time and a little bit the last call I was on. So I want to ask, I don't know if you have any info or recommendations on self-directed IRAs, but I definitely need to look into that because I haven't tapped into that source of funds yet, and I would like to.
Yeah, no, don't know much about self-directed IRAs. I did have a speaker a few months back. His name's Damian Lupo. His product is called the EQRP. I can send you the recording. Looks like we're about to close.
Okay.
But a really nice guy, and he has all the information on how that stuff works.
Okay.
And the EQRP, he says, has a lot of benefits that a self-directed IRA does not have, especially when you're using that to invest in leveraged deals.
Yeah.
Because you're taxed a little bit differently.
Okay. Yeah, I would love to check it out.
Okay, I'm gonna write myself a note and make sure I get you that recording.
Awesome. Thank you.
I will see you in the main room.
Sounds good.
Hey, Chad. Glad you made it.
Thanks for having me. I was just telling Larry how you invited me. I appreciate you being here. Thank you.
All right, Larry. Whenever you're ready, man. Take it over.
Cool. I'm gonna share. I do have slides.
And just by the way, while Larry's presenting, any questions that you have, you can interject, or if you're more comfortable putting them in the chat, either one is great.
Can everybody see my screen? Awesome. So once again, thank you all again for having me. Just Larry, I do have a QR code. I think it's over here, or is it over here? But you see it on the slides as well. So, like I said, once again, just thank you again. Hopefully there's be some value. There's a lot of good experience across multiple rounds from people starting off with one or two properties like Chad, versus you got your contractors like Ryan, and then you got your agents and big time investors like Suzanne up here. So hopefully I'm able to go across the board and just be useful for everyone at that point. So so just let's say info about me: born and raised in Norfolk, Virginia. Like I said, love accounting. Ironically enough, love real estate as well. It all kind of started off with a love story. Like my first indication with tax and accounting, they start off in high school, and a high school crush who is not that lady who was in the picture that you're looking at right now. It was actually a high school teacher that got me started. Didn't work out for whatever reason, but neither here or there. But it all worked out for everybody when it's all said and done. So, but now I kind of take this and use it as my passion to kind of help people achieve financial freedom through real estate and taxes, because I know a lot of people get into real estate to make a lot of passive income, but we want to make sure we have opportunities to keep as much as we make as well. So I'm really big on interruptions. I don't like going through the slides cleanly. That means I have not provoked anyone enough to ask a question. So if you have anything, like, please interrupt me. If we don't get through all the slides, then maybe we had a good night from my perspective there. So quick agenda. I guess I did an introduction already, but we'll go over like passive income itself and the benefits of that, depreciation, which everyone's probably heard of, and we'll go into a little more in depth there, and then how that all kind of ties into real estate professional status, or reps. I'll use that interchangeably, and material participation, because from what I'm hearing from a lot of people today, that there's a gap in that understanding of, I thought I was going to be this, but I can't get these losses because I don't have that. So we're going to clear that up, and then wrap up session, or wrap up slide, and then we'll go from there. So there's no questions, no concerns. We'll keep it moving. So quick disclaimer: even though I am a tax advisor and um, I consider myself good at what I do without really still being humble about it. I'm not your tax advisor. I would like to be, but it's all for informational purposes. Like, please, 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 like verify with your tax advisor and your research on if what I'm saying applies to you. But it's all just going to be kind of just high level, general aspects of it there. But please make sure you're consulting with your own advisors or reach out for more information that so to make sure that um, you're not going down the wrong path that's going to lead you to a brick wall. So a little more of an intro of why I love real estate. I'm fairly sure everyone has read this book at least, and but there's the first one of the Rich Dad Poor Dad. But then once they read this book, and then as a tax accountant, tax advisor, you start to think of where like okay how does this all apply from that standpoint there to like my business and my profession and to be able to actually like explain to people like how your income is taxed depending on which quadrant you're in goes a long way. So a lot of us start off in the employee realm and that's your 30 or 40% of your income, and then as we get specialized and you get the Ryans and the Suzannes and then like okay you all are contractors, you all getting your self-employment, but then you start getting hit with self-employment taxes, and that's where that 15.3% kind of comes into play there, and that's why you see a lot of self-employed individuals getting hit with half their income. So especially a lot of athletes and whatnot there. So we try to be more consultants of getting people from the left side to the right side, whether they're going to build their business. I heard my 2-year-old. He's breaking into my office. um, so it's either you're growing your business so that you are a big business owner, so you're not having a job per se. You got those systems in place, or you're just going to be an investor in the whole mailbox money and all of that. Wes, get away from the door. Come here. Where's your mama at? And how'd you unlock the door? Sorry.
All right, he can join us.
Come on. Come say hi to everybody. You say hi?
Hi.
Okay. You gonna talk taxes too? Okay. So anyway, so we try to consult with people on getting to the I quadrant really more often than not because I mean that's where the true tax savings are. So as we go through this slide, like hopefully this will kind of resonate with a lot of people, and we can start to grow our portfolios the right way from here. That 0 to 10% is rather enticing. Excuse my distractingness. I have typically flow with this, but so passive income. So mailbox money, however you want to call it, like that's why we're really into this. But the true benefit is, don't touch that, is that the income itself, the IRS considers passive like income from rental properties as per se passive. And as we all know, there's nothing about real estate that's passive, whether it's finding the deal, doing the renovations and all that there. So for them to say it's per se passive is a bit of a slap in the face, but it does have its benefits because one, you still get the same deductions as if you're running a business itself. So like the laptops you want to buy, supplies and all of that, vehicles, you still get those same deductions, but also you get to avoid the self-employment tax that we talked about earlier. So that non-passive income, like being an agent, you can't be loud and me talking. Like being an agent, or like being a contractor, or being a broker, or being an accountant, you're going to be hit with these extra taxes there on top of what your tax bracket that you'll fall into there. So we want to make sure that we're maximizing opportunity to make more passive income because that's instantly tax savings there. Other than just like, hey, I decided to turn my job into my profession, to my business, and now I'm still getting hit with more taxes, even though I'm not a W-2 employee anymore. Questions, comments? Ignore.
Well, maybe you could clarify. So
Mm-hmm.
when you what's that cutoff between the self-employed versus the passive income? I mean, how do you identify that from a tax planning
So,
perspective?
so the government sees as if, okay, you're gonna leave now? Great, go over there. If you are materially participating within your business, you are actively involved. That is non-passive activities. From that standpoint, there, they consider real estate per se passive because even though you're actively involved in getting the deal in order and but the actual operations of it, more often than not, people are just throwing a property manager in there. So unless you are managing the property yourself, like you are, and we'll address that later when we talk about real estate professional status. But unless you're actually doing that, most investors are just okay. I bought the property. I'm going to put ABC property management in there, and then I'm just doing asset management, just reviewing financials and checking my bank account to make sure the checks are coming through from that standpoint there. So that's kind of where that threshold lies at that point.
Can I ask another question?
No, it was all. Hey, this is your show.
So cash flow from general operations, is that treated as income or treated as capital gains?
So it's treated as income. So you're talking about just the operations of a business
Right.
or property.
I get a $700 check in a month from a passive investment I have. That's considered income.
Yes.
Got it.
And it's also important that it also rolls that question to people who flip properties, because because you're holding the property to intent to sell it, it's not considered a capital asset. It's considered inventory. So the sale of a rental property is not capital gains. It's short term. It has a short term effect, which is just basically your ordinary tax rates as well as the self employment taxes as well. Anyone else? Stumped everybody already? Great. Um, so depreciation, the ghost expense or phantom expense, and I can't see everyone. Does everyone have at least a rough idea or understanding of what depreciation is? If
Why don't
not,
you just give a quick
yeah.
60-second over?
So the general premise is that um, the government realizes that properties go through a bit of wear and tear over a certain time, so they have set certain useful lives, is what they say, useful lives or valuations of like, okay, the property typically is going to last this long. So once you bought the property, let's just say you bought it for $1 million, it has a 80% building improvement value, 20% land value. So that 20% land value, you put that to the side because you cannot depreciate land. Like land does not disintegrate in value unless you're depleting it, and then that's mean we're drilling for oil at this point. So a whole different like topic. We're not getting into that at all. So depreciation on that other 80% or that $800,000, the government is allowing you to make up that like depreciate that cost over a certain period of time. And typically you have 27 and a half years is the useful life for the building of a rental property itself. So that's why it ends up becoming a ghost expense, because I mean, unless you balling like Ryan, who's spending $1 million on the property, you most likely are getting a loan. You're only going to put however probably no more than 20-30% down, depending on the type of loan you're getting. And then you're able to maximize the full 100% of that building value to depreciate over that time. So it could potentially be a huge tax savings like strategy there, depending on when you're buying, what you're buying, how big you're buying, how you maximize depreciation there. So very, very important to get into depreciation. A lot of great benefits associated with it. One, that whole non-cash expense aspect of it. A lot of times, especially with taxes, it's this aspect of you have to keep spending money in order to get deductions. It becomes counterintuitive sometimes. So real estate is unless I'm aware, unless I'm completely blindsided by something, like it's the only investment vehicle where you have this non-cash expense where like, okay, you didn't have to put 10,000, you didn't have to buy a vehicle to get this write-off, or you didn't have to like uh, put donations in to get a write-off. You bought a property with a loan, but you get the full value of the tax benefit without having to spend the full value of the property itself. So something very valuable there from that perspective there. Depreciation, once again, it can reduce your taxable income from your rental properties. Like it could reduce it down to zero. It could potentially reduce it down to a loss. And now you have the losses per se. So that's where you get to the Trumps of the world, the Kiyosaki's of the world, the other Google, mobile Googles, where like, okay, they're taking these tax losses, even though the properties operate in the black, net NOI wise. Once you put depreciation in, it's potentially going to be in the red tax wise, and then you can potentially offset that against non-passive income, your W-2, your business, and we'll get to that down the road as well. But like I said, the potential is there. I just want to just kind of document that and explain that at a high level right now. So then, once that, as I mentioned before, if you're able to take advantage of certain things like cost, actually maximize your depreciation in the earlier years. So from that standpoint there, where if you can, instead of doing the 27 and a half years, you can recognize 30% of that all in year one, and you have this income from other places coming. You now have hundreds, tens of thousands, and sometimes even hundreds of $1,000s of losses to potentially offset other investments and other types of income as well. And like I said, we'll dive into cost segregation and how that basically becomes a bit of a, what some people call the steroids to depreciation from that standpoint there.
Hey, Larry.
Who's that?
Yeah, hi, I'm Kim Gomez.
Hey, Kim.
Hello. Just a quick question, because you did say it, but I didn't really hear it well. How many years can you use depreciation?
So for the building itself, it's 27 and a half years.
27 and a half. Okay.
And I keep
From the moment that you buy it.
From the moment that you put it into service.
Okay.
The moment that you buy it doesn't matter, because you can buy a building with no roof on it, but it's not rentable, it's not ready to go from that standpoint there. So, and that's interesting that you brought, because I have a client in Texas. They bought a property in 2020 and under their previous tax advisor, they started depreciating it then, but they didn't really start operating it until 2021. But once I saw it, like, okay, they had to amend their 2020 because they couldn't take advantage of the tax losses then. They could take advantage of the tax losses in 2021. So I would say it's the timing of it and just knowing when you can place into service, or basically you're marketing it as it's ready to be rented out. All the work is done, or whatever from that standpoint. It's livable is basically the best way to put it at this point.
Perfect. Thank you so much.
No problem. Great question.
I have a question for you too. Are you going to get into bonus depreciation at all?
Maybe.
Okay, I'm curious about it because I've heard about it. I don't really know a lot about it, but from the very limited understanding that I have, it's like if you are a real estate professional status, you can use passive losses to offset active income or W-2 income. That's very general, but I don't have all the details, so I'd just be curious if you could help me understand.
We're right at the next light, Suzanne. That's the next light. You just turned too early. Now we got to bust a U-turn, and we're gonna make the right at the next light, and we'll get there. Don't worry, I got you, Suzanne. I got you.
Hey, Larry, can I ask one question before you move off this topic?
What?
You talked about when you put it into active use. What if you have some type of I don't know, disaster, fire, let's say, and the building or a good portion of the building is taken out of service? Then you spend, I don't know, 6 months renovating it or rebuilding it. Do you stop depreciation for any reason, or do you redo the depreciation if you have to go remodel, let's say, half the building?
You'll still do depreciation, but then you're getting more into partial asset disposition. But if you're talking about full burnt out building, you're talking about full asset disposition. And what that means is that, um, let's just say the roof caught on fire. Isn't that a song? Like the roof. The roof. So the roof is on fire. So the roof is on fire, and you've been and the roof itself is considered 27.5 year property because it's attached to the building. You cannot have a building without a roof. From that standpoint there. So if you're 10 years into the value of that building, you have to continue the depreciation, but there's still value left over. So if the roof caught on fire, you then could potentially write off the value of the old roof and be able to expense that because you're having to bring in the new costs of the new roof and depreciate that over the new. So the different components start to depreciate over a different amount of time depending on how it's all broken out.
All right. And so I imagine you'll charge me more than when doing that accounting at tax time.
Most likely, yeah.
Yeah. Okay. Thank you. I mean, I asked that because we had a property last year that it did have a fire. We were selling it, so I didn't have to deal with that. But that was a question that I was wondering if we did keep it, and we had to go do these pretty serious renovations and repairs and replacements, how would that play out? So you actually clarified that quite a bit. Thank you.
Yeah, and because a part of that is, and this will tie into like this is kind of the first step to where Suzanne was going, as well as like the cost segregation helps put the value onto the different components of the building, and because as the phrase suggests, is like it's segregating the cost of all the components. And you have the building, which is called residential. You have the personal property, appliances, furniture, and all that. And then you have land improvements, like your parking lot fences and all that there. So we're breaking that aspect of it there, so that we now know the value of the roof that you're going to be replacing, and then we can figure out what that cost is to actually write it off. And there's other ways to do it. It's called a PPI index, and I keep forgetting what the PPI stands for. If any finance majors are on it, you all probably know it. But also the benefit of and the purpose of the cost segregation study is to maximize the time value of money concept there. Because one, if we have 5, 7, and 15-year property, they all depreciate at a faster rate than 27.5 years. Just basic math at that point there. So you already are seeing a benefit from the cost segregation study there because you're able to write these things off sooner. Now that we know what things are 5, 7, 15-year property, then we maximize the tax changes from 2017 that says anything that depreciates less than 20 years or less, you can fully depreciate that in year one. So now we're saying, that's why I say now we're talking about 10, 20, 30% of the building cost is now fully written off in year one. And that can create a huge deduction if you're talking about, and I've seen people benefit from single family houses. I've seen people benefit from, of course, we're talking about larger properties, it even gets bigger and better at that point there. And you catch a lot of apartment building syndicators promoting that they're getting a cost segregation study and talking about bonus depreciation and making it happen and sharing those losses with their investors from their standpoint. Suzanne, is this where you was kind of going with at this point?
Yes, thank you.
Yeah,
And how many, well, I do have one question. How
Huh?
many years has bonus depreciation been around? Like, what if we missed out? How many years have I missed out on it?
So bonus depreciation has been around forever. You want to grab it? Hey, mommy's gonna get you. Yeah.
Mommy?
Yeah, there she go. Bedtime here. Sorry. So bonus depreciation has been around forever. He's fine. Don't worry. The thing is, it's always been 50% bonus depreciation. And then Trump came along. That's why I tell people, if you were just from a different planet and you were just dropped onto in America when the tax changes came out, you would assume that the president was involved in real estate one way or another. Like the way those laws changed, and everyone that benefited from it were attached to real estate in one facet or another. There. So bonus depreciation has been around forever. It's been roughly 50%. It got spiked up to 100% in 2017, and then starting January 1st of 2023, does the 20% phase like sunset or phase down, and then so forth and so forth. So the tax community is expecting there will be another law passed probably by 2024 to put it back at 50% where it was beforehand, because they doubt that it's just going to completely disappear, because it's a huge incentive for buying whole apartment building rental property investors standpoint there. So, but if you have something and there's a timing of it where, okay, you bought the property in 2020, you didn't know about bonus depreciation until now because some guy in a nice T-shirt mentioned it. So you could amend your 2020 and factor that in. If it's older than that, you can do what's called a form 3115. It's a pain ass form to fill out, but you want to make sure that it's worth it, because also remember, when you're talking about separating the different components of the property, a lot of it's going to be 5-year property. So if you're already at year 3, 4, 5, like you already have you already took that depreciation up to those years, so you may not be getting any additional benefits. I put my threshold at 3 years. It's like, okay, if it's older than 3 years, I mean, other than just the aspect of you maybe want to replace something and you want to know the value of that component being replaced, you may be able to get some value there. But if you're just talking about maximized depreciation, like you already have tipped the scale and you already have used it through at that time, you're not really seeing any additional depreciation at that point.
Thank you.
Thank you. Good stuff. I told you. Next light. Anyone else? Great questions.
I do have one quick question. Sorry. So you buy let's say a larger asset and you don't do cost segregation. So everything is going to be the 27 and a half years minus any new capital that you spend, right?
Mm-hmm.
You're not going to be able to take advantage of the bonus depreciation except for any of the new stuff. Let's say you go buy a new laundry machine.
Yeah.
That you would get, but otherwise you have to do the cost segregation and the bonus depreciation go hand in hand.
Yes.
Got it. Okay.
Now, there's other ways. Like I said, that's when you kind of get into the price point indexes and all that. Okay, you bought this property in 2018. The cost of certain components would have been this much, and then having to backtrack to what that value is, so that, okay, it should have been appreciating at this amount, and then we got this much value left over, so that even though you didn't get a cost seg done, you're able to write off a certain amount of value and get that deduction that year. That's not depreciation. That's the asset disposition part that I was talking about earlier. So like I said, there's multiple. That's what I say. That's why people get too caught up in just the depreciation side with cost segregation studies. Like there's other benefits. It's someone properly explain it so that you fully understand and can make an informed decision at that point there. Asset disposition. Next slide. So I mean, and that's kind of where I was like getting to with the whole roof aspect of it, because if you don't write off the value of that roof that caught on fire, you're now depreciating 2 roofs, because you have to depreciate the new roof. You just can't expense it, even though, like I said, so you have to write off that from the original purchase price. So whether or not you got a cost seg, that amount is in that sales price of the building, or what the building basis is. You can use cost segregation to break it out, or you can do I know it's price index something, and some finance person is going to slap me for not not remembering the proper name for it. But you can go down that route as well, just to make sure that, okay, we're writing off what's being taken away from the building, and we're replacing it with the new component, because something has to be depreciated from that standpoint there. Producer price index. Thank you, Ryan. I knew somebody smarter than me would have brought that out. Questions? We good? Definitely a lot to digest here. And speaking of digesting, I feel like it's always good to have a visual analogy when it comes to stuff like this. So I like to use the Big Mac analogy when it comes to cost segregation. So this is your straight line method, and that Big Mac is going to depreciate at $3.99 over 27.5 years. Not much. I mean, you'll get a deduction, great, but not much there. But as we know with the song, to all beef pads, extra sauce, extra cheese, pickle, onion, sesame seed bun. So this is where the cost segregation kind of gets its, oops, too far. Kind of gets its value. Now we're breaking stuff out into its individual components. And then we can figure out, okay, what's 5-year property, what's 7-year property, what's 15-year property. And we can maximize that and write that off there. So hopefully this visual helps as well. I just like singing the song as well in my head and out loud at times. So hopefully this is helpful. And then I also have an example of a cost segregation study I've done for one of my clients, where we was able to find an extra $59,000 of tax of deductions, which equated to $17,000 of tax savings for them because of their effective tax rate. So this is kind of just a high level view of ones that we've done. This was only a 6 unit that we've done this one for. So a lot there with depreciation, cost segregation. Any other questions? I just want to make sure, because I know there will be probably a lot of questions with real estate professional status and hopping around a bit. So we good? Great. Joanna got it all figured out. Good. Real estate professional status and material participation. There is a particular reason why I keep including these, because a lot of times people just hear real estate professional status. And if you go to the IRS and you tell them you are a real estate professional and you should get all these losses, they're going to laugh in your face and tell you to go home. And that's basically, I have no evidence of that, but I have a good feeling that they will. So why is that a big deal? Like, as we mentioned before, because rental real estate income is the activity considered per se passive, there are limitations to how much losses you can take against non-passive activity. Your passive income and passive losses, that's all gonna merge together. You don't have to worry about the limitations there. It's just if you have losses in excess of your gains, your passive gains and passive income, you may or may not be able to offset that against your W-2 income, your business income, even your stocks. Where it's kind of weird that stock income is also it's considered non-passive, but it's like I said, but it doesn't have the same like view by the IRS from that perspective there, and that's more of a lobbyist aspect of it, kind of pushing that to have it taxable and non-taxable in certain brackets there. So, but there are exceptions. So if your modified adjusted gross income is $100,000 or less, you can write off up to $25,000 of passive losses against your non-passive activity, non-passive income. And then if you exceeding that, then for every dollar above 100,000, that 25,000 phases down $2. So by the time you get to 150, you're completely phased out of that exception there. So really beneficial for those who are just starting off and they may just have a lot of deductions and they're able to still maximize on this. And think of it as similar to the professional stock trader, where you can only write off up to $3,000 in losses if you're not a professional stock trader. So same thing, it's just magnified with real estate. Also keep in mind another exception: if you sell your rental property and you have passive losses like built up from that one property, those now activate all of those to go from passive to non-passive, and then all of those can start to offset your W-2 income. And there's now real estate professional status and material participation, and we'll get into that in the next slides. But regarding the big deal and the two exceptions, we all pretty much everyone covered there. Silence is golden. Chris, you went on mute. Go ahead, sir.
You're good.
Cool. So real estate professional status and material participation. There are 2 steps, and that's basically what we're talking about now. And you must track your hours. We're not talking about what your job title is. We're not talking about what you do for a living. It's just, are you a real estate professional, and are you in material participant or hands-on involved with your own rental properties? So to be a real estate professional, and I'm assuming a lot of people know, but we'll cover it, is to at least 750 hours and more than half your in a real property trade business that you own at least 5% of. Very important to get all that out, because it's very difficult to get that if you have a full-time job or you're somebody like me. Like, even though my profession is to serve other professionals in real estate, we're not dealing with the property. Like, we're just dealing with paper and taxes, which there should be some benefits there, but we don't get anything, but that's fine. But if you're into the contracting, the property management, the leasing, if you're an agent, you're in this bucket. So Ryan, you're in this bucket. Suzanne, you're in this bucket already. I said, we're just kind of making sure that we're getting those hours tracked, and it's very important to just kind of just hit that home, because if you are audited for reps, they will top 1 or number 2 requests, and it's probably number 1 is what is like, let me see your time log, let me see how you're tracking your time. And as annoying, as tedious as it is, you can blame doctors in the 70s for this, because they're the ones that were just dabbling in real estate. They won't do anything, and they started taking up all these losses and offsetting their doctor physician income, and the IRS decided here, but it starts with tracking your hours. But as I mentioned before, like, none of this matters. Like, you can just you can flip all the houses you want. You can do all the rehab work that you want, or sell as many houses as you can. That doesn't mean anything if you don't have your own portfolio and you are involved in your own portfolio. And that's material participation. You are actively involved with your rental property, with your rental activity. So that's basically day-to-day operations. So not just like, hey, I got a property manager, and yeah, you can track the hours for managing the manager or managing the contracting team, but like it's still a lot to, like, you have to build up a lot of that, and you're probably only meeting your property manager once a month. Your contractor comes and goes, and there's multiple tests to prove material participation. One is that you are the property manager, and you probably make up 80% of the hours being tracked with the property. 2 is that you worked 100 hours, 100 qualifying hours, and more than anybody else. So, like I say, if you do have a short-term rental, that none of the individual cleaners has more than 100 hours, or has more hours than you, and you have over 100 hours there. And then the third one, there's others, but those the main 3 is the primary property manager, 100 hours and more than anyone else, and then 500 qualifying hours. And those qualifying hours are real estate professional state hours. So you can't have them play both roles, but it's construction management. It's not just one. You can combine. You can have some hours in construction, some hours in property management. You can combine those as well. You can also combine properties like that you have as well. So the larger your portfolio, the stronger your case is it's called a non-election, where it's like you're grouping the properties together. It's okay, I didn't put 500 hours into one property. I put 500 hours in a combination of 10 properties. and that's doable from that standpoint there. Um, Also, keep in mind with these two steps is that if you're married filing joint, only one of you can be a real estate professional, but both of you can contribute to material participation. So you may have I have clients where I have the real estate hungry spouse, and I got the spouse that really doesn't care, just honey, don't lose all our money aspect of it there. But if that other spouse is involved with the property, then he or she hours are now like included into that bucket as well. So a huge thing to kind of keep in mind there. And also, and for all my LPs out there, since you do not have management control or management decisions in your syndication, you cannot count like those hours. Like those are just investor hours that you're putting into that property there. That doesn't mean you can't group your losses from those properties to properties that you do manage and have day-to-day operation control over there from that standpoint. So you still can group those, you just can't claim the hours from your LP positions in those. And the reason why I put the short-term rental, that's what the STR stand for there, is that if you can, there's a carve out in the code, and the tax community is probably expecting a change in this in the next 2 or 3 years because everyone's flushing towards short-term rentals and everyone's benefiting a lot. Is that if you can prove that your property, the average stay is 7 days or less, and you can prove material participation, then you don't have to prove real estate professional status. So now you have these losses, and you don't have the whole 750. You don't own the real estate business and all that there. So you have a full-time job. So a lot that I just kind of dumped on everyone there. Um, I'm gonna take a step back and just see questions, comments, concerns.
I'll ask a question. Larry, what about, so on the tracking of those 750 hours, is there a kind of a standard format that the IRS wants to see, or is it everybody just does it however they want to do it?
There isn't a standard format. The main thing they want to see is date, the amount of time, what was done. The more details, the better. Like we have two templates that we provide to our clients for their use as well. But I mean, people use their calendar as a means of kind of tracking everything from that standpoint. There, some people use QuickBooks logs from there. Some people use pen and paper. God bless their souls, but they write it all out and they keep it moving from there. So, but yeah, there's no standard IRS template for it. As with most things that benefits people, they don't provide any guidance on that.
Okay. I have a lot more questions on that topic, but I'll save them for offline.
Nice. Anyone else? I said, I know I try to not to get too geeky with this stuff, but I want to make sure there's an understanding here because more often than not, I'm hearing I'm a rep, I'm a rep, I'm a rep, but they do not have a rental property. I know I keep picking on Suzanne, but she's the prime example where I like to get people to, especially a lot of my agents and brokers, where it's like you see all the deals, you can close on more of them. If you just hold one of them, you'll see your tax situation change. And I imagine she could probably speak to the congregation of like how that has benefited her and her tax savings from that standpoint there. So I'm not gonna put her on the spot. I just like picking on someone, and she's the victim tonight.
Yeah, I didn't know. Well, I hope my tax person knows about the short-term rental bonus. I mean, it's pretty easy for me to be able to qualify as a real estate professional in any case, but I had no idea that you didn't need to if you can prove less than 7 days occupancy by your guests.
Yeah, just make sure because you're a real estate professional that and I know and depending you have a mixture of short-term rentals and long-term rentals. Once you go down that route of okay, I'm only going to treat these short-term rentals for material participation, then you cannot group those with your long-term rentals. Like once you separate them, then they cannot be brought back together.
Okay.
So in your situation, it's fine to keep them together because I mean, you're a real estate professional. But if you wasn't, if you were I don't know, a DJ, then you will want to potentially make that separation because you want to start to claim losses off of those because you're not as active involved with your long term runners, and you can improve and you can improve reps from there. So just something to keep in mind from that standpoint there.
Yeah, nice. I do have to jump off. I'm late for an engagement, but thank you so much for all your info and time. It's great to see
Thank you.
Thanks for
Take
joining,
care.
Suzanne.
you next time.
Hey, Larry, we got another question in the chat from Molly. She wants to know if you can elaborate on how you can add material participation hours with a spouse.
Yeah, so let's just say your spouse is, let's say you're doing the actual management, dealing with the tenants and all that. So your hours go on material participation there, and your spouse is doing the construction work. So those hours then all kind of go into there. So the that 500-hour bucket, both of you all will contribute to that bucket. The 100 hours and more than anyone else, you two contribute to that bucket. And then the overall, like if you all just kind of the end all be all with the property, where you have a property manager in place, but your spouse is doing this, or you're kind of doing something else that qualifies, then that's how both of you can contribute to those buckets there.
And then just to clarify, um, those hours cannot be combined to qualify for reps status, correct?
No, no, like whoever's going to be reps, like that's solely on that person to get his or her own hours there.
Yeah, it's Chris, my wife's account. That makes a lot of sense. I appreciate that.
Oh, what was that? Is that Molly?
No, it's Chris. I'm on my wife's account.
Okay, I was like the name and the voice wasn't going together. I was so
No,
confused.
I appreciate that. That makes a lot of sense.
Yeah, I'm glad. It's a good question because, like I said, just those is it gives the opportunity to those who are like, okay, if you want to get your spouse involved and he or she wasn't ever interested, like this is their chance to dip their toe in and actually help towards the tax savings for the family. But that's all I really have. Like I said, I just want to kind of go through that stuff. But I mean, right now, as I tell people, like there's always a three-step process for me of just kind of consult with the right professionals, and that's even with the right tax advisor as well. Are they familiar with real estate? Are they familiar with your area? Or if they are familiar with real estate, are they familiar with your own investment strategy from that standpoint there? Because like so many different strategies to make money in real estate and how to save taxes there, and then work with your teams on putting that plan in place and then execute and reassess and just see what because right now during tax filing season, this is the reassessing point where it's like, okay, here's what we all talked about throughout the year while we were planning. Let's see how, like, here's what we projected to be, and it should come out a certain way. If not, then where does those edges need to be smoothed out at from there? So I always like to end with this quote from Jim Rohn, because we're all in this for just to kind of our time. I mean, at least for me, like I know it's very very crucial for me to get control of my time, and real estate allows that for me to spend more time with crazy kids running around and all of that stuff. So, but thank you again. Like, if you have like any other questions, like comment, like please, like I'm here. I'm here all night. Like, like grateful to kind of share and add value where I can. So, and he's fine. Don't call the people on me. He's fine.
You have been working hard, huh?
Yeah, let's say that.
Very thank you. This is awesome information. Like I said, I really enjoy this stuff. I started reading Tom Wheelwright's book Tax Free Wealth, and what made it click for me was like early on in that book, he talks about how the tax code is written basically as an incentive guide. You do these things for the government, you provide these services, and they reward you with tax deductions and just again how powerful this can be for anybody out there. So I really appreciate all your knowledge. If anybody has any questions, any other questions?
Yeah, it's really huge. It's a good point where it's like the government doesn't want to build houses. The government doesn't want to provide food. They want the private sector to do it. And as with most things, if they want people to buy houses, then they give a mortgage interest credit. They want people to invest in certain properties, then they'll provide depreciation, or they want people to provide some type of like affordable housing. That's why they give low income housing tax credits there. So like if you want to get an idea what the government wants us to do, like just look how the tax code is kind of written, and you can see where the incentives are from there.
All right, well, we are about 12 minutes over, but
I'm bad.
if anybody has any final questions, speak now. We didn't get to do any breakout networking, but we did last time, I think worked out pretty well. Is I left this chat open. You guys feel free to turn your screens on, introduce yourselves. I always tell everybody, you never know when you're going to meet your next partner. It's a perfect opportunity to put your name out there. Feel free to drop your contact information in the chat, exchange information, and take conversations offline. Yeah, we'll go ahead and just leave this open if you guys want to hang out. Larry, if you want to hang out, if you got to go, I know it's almost 10 o'clock over there. So
yeah, nice. Thank you, Larry. Really appreciated it. And I've got my other 10 questions that maybe I'll just shoot over to you later, but great stuff.
Yeah. Like, please, like, use the QR code to connect. All my contact information be up there. Cell phone, just give me 48, 72 hours to respond, considering the time of year for me. I'll also put my link in the chat as well, so everyone will have that. But yeah, like I said, definitely grateful. Like thank you so much for this, and I'm glad that this was valuable to everyone.
Yeah, and if you're okay with it, we'll share the recording. We had a lot of people that registered that didn't show, and that sometimes happens. You know, it's just life. But are you okay with us posting this recording and sharing it with the broader group?
Yes, please. Yeah, thank you.
Awesome. All right, and then just as a reminder, next month we'll be doing we're looking to do a session on raising capital for real estate investing. So if you not sure how to do it or want to learn more, maybe you have thinking about finding a deal but not sure where the funds are going to come from, we're going to do a session on raising capital. Ryan, I actually have to drop as well, but nice meeting everybody.